Welcome to the Old Capital Real Estate Investing Podcast with Michael Becker and Paul Peebles. During this program, you will hear interviews with real-life successful investors who will share their stories and provide useful advice on how to acquire, finance, and operate apartment complexes. Now, here they are, Michael Becker and Paul Peebles.
Welcome to the Old Capital Real Estate Investing Podcast. I'm your host, Paul Peebles, National Underwriter for Old Capital. And joining me today would typically be the Mayor of Beckerville, Mr. Michael Becker, but he is on another due diligence assignment. He is a busy guy, so we wish him the best of luck on his next acquisition for his team over at SPI. So joining us in the podcast today is Ricardo Hinojosa. Ricardo Hinojosa with Old Capital. And Ricardo, thanks for joining us. Thanks for coming into the podcast.
Glad to be here.
So we appreciate Ricardo being in the podcast. But Ricardo, let's talk a little bit about some of the things that are going on in the Old Capital world these days. Tell us a little bit about the September 13th Old Capital Multifamily Conference.
Yeah, it's going to be an exciting event. If you haven't seen the emails or some of the marketing stuff that we have out there, we're expecting, 700-800 people maybe?
Well, it has the capacity to have 100,000 people at AT&T Cowboy Stadium, but I'm hoping we don't have that many people.
So it should be a great event. A lot of investors, brokers, everybody within the B and C space. That's kind of the focus, B and C apartment space here in the DFW market. Our keynote speaker is going to be
Roger Staubach.
Yeah, so we're really excited about that. Not only is he famous for his football playing days with the Cowboys, but he also has a vast experience in real estate. So we're going to bring him in and gain some knowledge from Roger and his background.
Yeah, it's going to be an all-day event. So find some way to get onto an American Airlines or Southwest Airlines plane. Come on down and see us in Texas. Make sure you say hello, and we'll make sure you get connected and networked into the Texas B&C apartment market. So we look forward to having you come down. Go to the oldcapitalpodcast.com. oldcapitalpodcast.com website and get in the game with that. Second thing I wanted to remind you about is on June the 21st, up in the San Jose DoubleTree, we're going to have another one of our get-togethers, a little networking event, and you're going to have a chance to sit down and listen to three apartment operators that live in the San Jose, San Francisco Bay Area, but own real estate in Texas. So I thought we'd just kind of sit down. We're going to kind of pick their brains. We'll probably have 125, 150 people. Our last one was fantastic. I think we had 90 people that showed up, investors all throughout Northern California. And we're excited about that because most of the time those investors have to travel all the way from San Jose out to Dallas. Well, we're reversing it. We're coming out and seeing you. So go on to the Old Capital Podcast website. Reserve your time to be available to come out on June the 21st. We'd love to see you out there and get a little bit more knowledgeable. Again, we're not selling anything. We just want to network with you a little bit and kind of have you understand a little bit about what's going on. So we're excited about that. So in the podcast today, we have a success story, and we've had them on the past. It's probably been, how long has it been?
About 2 years.
About 2 years. And I think we focused on their first deal or their second deal, or maybe it was their third deal, or there was I forget how many deals that we had, John, the first time. But I think we're going to talk about their last two transactions because I think there's a lot of knowledge that we can gain by listening to these folks. Again, just great successes. And I want you to meet Bhuvan Pratima Sharma. Thanks for coming on, guys. We appreciate your business. And we're anxious to have everybody understand a little bit about what you guys do. So I'm going to kick it over to Ricardo, and let's kind of talk a little bit about how you became successful in apartment investing.
Yeah. So thanks for joining us, guys. We appreciate it. So before we get into more kind of recent events and what you guys are doing in the multifamily space, give us a feel for kind of how you got started. Take us back to the beginning.
Sure. So thank you, Paul and Ricardo. It's an honor to be on your podcast. About 5 years ago, we were looking to break out of corporate America, to have the financial freedom. And it's about that time we started looking into the real estate, and we joined a local real estate club, and that's where we met Paul. And that's where we started learning from Paul.
So let's talk a little bit about your background. So Bhuvan, tell us a little bit. You were a corporate America kind of guy. Tell us a little bit about what you did before you got into real estate?
Yeah, well, thank you very much, Ricardo and Paul, for having me here. It's always a pleasure to be here with you guys. My prior corporate world, I was about 16 years in audit and compliance. My job was to basically slap all my people that what they're working on and what they're doing wrong. And my job was to not trying to find the wrong thing. My job was to what are the control gaps in the company and how we can improve those gaps. So it was a good story. I overall about 34 years in corporate America. And Paul, last year, I decided to turn my resignation as soon as we bought our fourth property in Dallas.
That's amazing. So, I mean, you've done a great job, but I mean, we're going to tell tales out of school. You had a lot of your money in retirement with the stock of your old company, if I remember correctly.
That is very true. Both me and Pratima, we had so much money that once the market turned around, we lost almost all of our 401k and IRA. But we never looked back. We wanted to move forward, and that was the reason our goal was to start something else and don't fall back behind. That is where the real estate come in.
And did you guys go into single family right from the beginning, or did you guys go right into multifamily?
Well,
We started to look for single family. And we did some, online learning and some research. We started looking for houses with a broker, did some analysis, but soon we learned that, one house will not be enough. We'll have to get multiple houses. And then managing multiple houses with our full-time jobs will not be easy. So it would be better to move into
Scalability
multifamily.
wasn't there. I mean, you could have 5 homes, at all different locations, or you can have one 5-unit apartment building.
Absolutely.
Yeah, so sometimes it just doesn't make sense to have the single family business if you're thinking about coming into the multifamily and making this a business.
Correct. Yeah.
True.
So, Ricardo, tell us a little bit.
Yeah. So you find the mentoring group, the networking group. Did you just jump in right away to do your own deals? Did you do passive investing? How did you guys come to be in terms of, going after your own deals?
We first took a lot of classes. There were a lot of seminars, webinars which were available. And then we decided to jump into a passive deal to learn exactly how multifamily investing works. And then we moved into our first deal.
Did that passive, the person you put the money into the passive investment, did that deal sponsor, did they help you? Were they engaged in trying to teach you?
Yes, they were great mentors. We learned a great deal. They allowed us to, learn due diligence with them. They allowed us on the property anytime we needed to learn anything. So
That's great. We'll come back to that in a second because I think that's something that you guys do. So we'll talk a little bit about that down the road here.
Sure.
So taking that leap to kind of make that first step and going after your first deal, what kind of pushed you over the ledge, so to speak, to make you feel, comfortable that you could do it on your own?
Let's go back a little bit on it. How we started real estate. We wanted to come back is when we started real estate, and Paul and I and me and Pratima, we sat on one Sunday afternoon to draw our plan, and we still had the Starbucks napkin at home. Paul and we sat down. It was literally Sunday afternoon around 2:00, and he said, "This is what you guys should do. We knew he knew exactly what our financial situation was. He drew it. Let's do the first passive deal. It was 2013. I remember it was like Pratima. I don't remember. It's like May or June, something like that.
Right. Yeah.
And then he said, "You do the first deal in 2014. I want you to buy a property which you guys can manage. Small enough, not big enough, but that's what we did." And that is where we started our first property. We did the passive investment, then the first property, then the second property, and third property, and so forth. So I just want to go back a little bit, how our career started. And we had planned that within 5 years, one of us will take retirement from corporate America. And I was able to do that. I was able to replace my earning last year.
Outstanding.
Yeah.
Congratulations. That's huge.
Yeah, they needed to talk with Ricardo these days.
And but it all started on the back of a Starbucks napkin with a little bit of, roadmap. And I think that's, Paul, you preach that a lot in terms of, sitting down up front, engaging with your team up front and putting together that roadmap because it's extremely important.
You just have to have confidence I mean, I've done enough of these transactions. I can kind of spot people that I think are going to be winners in the multifamily business. I picked enough horses that have won that you kind of have to lay out a game plan because they didn't have a comfort level yet about being in the multifamily business, but just talking with them and listening to what they wanted to do and where they were in their part of their lives. I mean, their sons were either in college or they're just getting out of college at that period of time. So and move on kind of said, hey, listen, I'm kind of done with corporate America. I want to focus on my next phase of my life or my career. And this is something that I want to do. So we sat down, for about 45 minutes or so, went through a couple venti chai lattes, and we just kind of put together a game plan and kind of figuring what worked and what did not work. So Ill Capital team, any of us are willing to do that. If you come to Texas or you just give us a call on the phone. We'll kind of talk a little bit about what you guys want to do and kind of figure out the right roadmap or path.
I appreciate it. So anyway, your question about what are we doing nowadays, right? I think that was your question related to. We've been very busy. So last year was our one of the successful year that we accomplished a lot. We bought our fourth property in Sierra Vista, 224 units up in Dallas. It was a deep value add properties, $2.2 million rehab we did in that one. We were able to stabilize the property within 3 months. Means that we were able to do all the major upgrade in 3 months. During that time, we were still able to manage our occupancy.
Above 90.
Above 90s.
Really?
So we continue doing that.
Let's talk a little bit about that deal because how was that deal presented to you? Did that come from a broker? Did it come from somebody that brought you the deal? Tell us a little bit about how you guys got access to a property of that size, 224 doors.
Right. So it was an off-market deal. It was presented to us by our property management company. It is one of the properties that they currently manage, and the owner of that property wanted to move to a bigger and better things. And so we heard about it and jumped right into it. And
Ricardo, does that happen too often that property management companies will tell you, they want to continue on having cash flow stream for their management? And, they didn't want to lose that property.
Absolutely.
Right.
No.
It definitely happens. I hear it all the time. It's good to be, in terms of networking in this business, knowing who's managing these properties is key. So, finding a deal right now is pretty much the toughest piece of this business. And we'll talk about this a little later, but getting out there networking, not only with brokers, but everyone that's kind of in the business and seeing the business. You've got to touch everyone.
So this property management company that they have managing all their properties
That's correct.
manages, 10,000, 12,000
Yeah, about
doors?
12,000
11,
units in
yeah.
Dallas.
Yeah, so he does a tremendous amount of property management. And so if you have a property management company of that size or one that has 5 properties, you got to touch them and talk with them all the time and kind of figure out what they're hearing on the groundswell of maybe this owner has a fracturing partnership that they don't want to put any more money in the property. They've already executed their plan. They want to get out. And before they start talking to the brokers, maybe it's good for you to talk with the property management company, kind of figure out maybe this is somebody that we need to start talking to.
Absolutely. So you heard about the deal. What did you like about it, kind of up front? What attracted you to it?
Well, so this was just like the deep value play. It was a great part of town, and we kind of knew the area. But when the deal was presented to us, and again, we went with Paul, and we reviewed the deal. We looked at the property. Obviously, the price was great, and the kind of value that we were going to put to the community and to the apartment itself. So, it just by looking at that, how we wanted to do to the community, we did that. So we could talk a little bit more community events, what we actually do at the property, but just doing the upgrade, give you a little bit background, the upgrade that we did. We had a plan. We knew this property we were getting in. So day we went in, very first week we had our contractor there. They were actually ripping the wood. We did the painting on this property with a new sign, brand new sign out there. We did the driveway. We went a new turf at the ground, at the soccer field. We talked a little bit more. We also did the water thing. We did the water conservation program. Property has a history of water leak. The water bill was outrageously high. Just spending the water conservation program, we were able to save 40% of the water cost.
Yeah, talk about a little bit about that. Some of these older properties, with soil shifting not only in Texas but different parts of the United States, is that a lot of the plumbing and the sewer lines, the plumbing lines that bring water into the property, sometimes they leak, and this one leaked tremendously.
Yeah.
What was your water bill before you bought the property, and what was it afterwards? I mean, you said 40%, but what does that really mean?
It was $270,000 for 228 unit property.
Wow. And so, and what did it become after you did the water conservation, and what did it cost you to do the water
So
conservation?
water conservation cost us originally $140,000, but we worked through our vendor. They were able to get us the free toilets from the city, so it ended up costing about $100,000.
So $100,000, and what was the bottom line number?
Monthly bill for water used to be 18 to 20,000, and right now we are at 11 to 12,000.
Yeah. So what does that really mean to an investor out there if you can save $8,000 or $9,000 a month times 12, divided out by a cap rate? How much did you just increase the value of the property by?
Lot.
Big number.
Big number. We talk about cap and other things. It's a big number. It's talking about thousands of dollars.
Yeah.
So you fix the water leaks, and then you also put low flow toilets on the property and the shower heads. So, the people were getting probably better service, but better toilets, better technology,
Correct.
and that you were actually saving the investors a tremendous amount of money.
Yeah.
Right. And I mean, that's what Ricardo was asking earlier. What did we like about this property, right? So we saw this value in it, that it's a deep value play, but this property is right in the middle of Dallas, in the heart of Dallas. And Dallas is one of the booming towns in the nation.
Why didn't the seller take the money out and do the repairs?
It's the seller had this property for about 20 years, and he bought this property dirt cheap, and he was just milking money.
Yeah.
He just didn't want to put any money in there. So again, the partner thing happened. So they just wanted to get out. They said, we just want to run away, basically.
Does that happen every once in a while, Ricardo?
Every now and then. Every now.
Yeah, sometimes these partnerships they may be at the beginning for 5 or 7 years, and all of a sudden they turn to 20 years, and then the partners decide, hey, listen, I want to get my money out of these deals. I've made enough money, or I'm not making enough money. Let's sell the property. And so I think in this one, like we just said, is that the seller notified the property management company, put a little birdie in their ears, and then told the Sharmas what to do. So let's go back and put a vision in somebody's head who's never been to see your property. Again, it's 224 doors. It is 2 stories,
Yes.
and it has pitched roofs.
Correct.
And what year was it built?
1970.
So 1970. And in the center of the property, it had a tennis court.
Yes.
That is correct.
Now,
So-
does your tenant base ever play tennis?
Absolutely. The kids are always at the tennis court.
But it's not a tennis court anymore. What is it?
So it is a soccer field. We converted it to a soccer field, and we just put a new turf. We have 150 plus children at the property, and they just love it. We just raised the fence up high, both sides, and kids are there from on Saturday, Sunday. They are there at 6 o'clock in the morning. They're about 10 o'clock. We have to put a time there that we park close at 9:30, 10 o'clock, so kids don't.
Yeah, you created an amenity. You saw the tennis court that nobody was using the tennis courts.
Right.
You put a brand new turf with some padding underneath that, so the
Yes.
kids can play it at all hours of the night. Keeps the kids on the property that they are not wandering around the neighborhood. Mamas can go out and take a look at it. Ask the kids to come in. They kind of know where the kids are at. You also have a swimming pool on the property.
Yes.
But I really want to talk a little bit about you guys transformed this property. So you bought it X, and now you've put in some social services that you really didn't have to do, but you're doing. And talk about what you're doing and why you're doing it.
Paul, this is one of the things that we wanted to, it's not getting a property, giving away to the community. At our property, we actually run an after-school program. There's 35 kids. They are free. It is subsidized through our YMCA. So kids come after school, we provide them the snacks, and we also provide them some homework assistance from different students. They come out. We have some of the pretty high-shot private school students. They come and help them out. That's after school. They also do summer program. And also that we also doing some adult activity for the adult, residents that we have, a lot of them don't even speak English. So we are providing the English as the second language classes for them so they learn English, how to talk and communicate. At the same time, we're also doing a nutrition program. So kids can learn how to eat better and healthy. Our manager, they take them to the local grocery store, help them read the labels, what is good and bad, how much sugar is there. So that's other thing we're doing. We are also doing a health screening program at our property. We invited our local hospital to come down and do some local screening, just a screening for the family, and they can do it. We are also working on another program right now is trying to bring a hospital to the preschool vaccination program so the kids can have the vaccination. So we're trying to do, these are some of the thing doing at this property. We do the similar activities at other property. We always have after school, before and after school party. And when the school kids actually goes back to school, we provide them some school supplies, some uniform they needed, whatever we can support them. This is all from our side. There's no investors coming in that situation.
So my question next is, why are you doing that?
This is giving back to the community. This is for our satisfaction, that if we have changed or touched someone's life, you have made a difference.
Yeah.
And also, it gives a great sense of community at our properties.
Yeah.
When you're there, like we upgraded the community center at Sierra Vista and painted this center, which was never painted for many years. The whiteboard was not white, it was black. And there was no TV for the kids. They often needed the homework assistance and all. So one weekend, we brought in a contractor and changed it all around, new paint, put actually a whiteboard there, a functioning whiteboard. We brought a TV and we got a computer there so that they can all log in and access to the internet and work on their homework. That, Monday when kids came back, they jumped up and down. They were in tears. We got how many? 60 some letters, parents and kids together thanking us. So, that's satisfaction that's, gets us going.
So what you don't know about Pratima is that I would kind of call her a tiger mom, where she has two boys that are pretty much geniuses. And, she was after them with a switch to making sure that they stayed in front of the computer and kept their nose straight and wanted, they've gone on to get their masters and things like that. But, when she took over this property, she kind of saw what needed to be done. And so she implemented these programs with Bhuvan to make sure that they were able to get these kids, not off the street, but focused on what was important. So thank you, my tiger mom.
Thank you, Paul. I appreciate it.
Appreciate it, yeah.
And all these programs, when you think about it, you're doing it because it's the right thing to do. But like you said, it builds a sense of community. What does that do? It keeps the property full, it lowers your turnover. So eventually, there's a definite impact to the bottom line. That's not the reason you're doing it, but it all helps down the road.
No, I think that's a great thing. Our property stays 100% pre-lease. We always have at least 5 or 6 people waiting to go join. It's just a community after school program. The work we do, make sure there's a clean area. Kids can actually live and they can go move around freely. They have a place to come and do the homework because some of these kids don't even they have never used a computer.
Wow.
Just provide them a very simple thing, very minimal effort, and they were just able to have a better life.
So let's talk a little bit about on that transaction. How many people signed with you? How many KPs did you guys have? How many key principals?
We have 2 KPs in that property.
And how many?
Actually, 3.
Three KPs. So, you guys are in the front of the airplane, part of the pilots and the co-pilots. You guys are definitely the pilots. And how many people in the back of the airplane? How many limited partners did you have on that deal?
Altogether, we are 32.
32 to investors.
Including us, yes.
Yeah. And so have you started to pay out a rate of return on the transaction yet?
Yes. It's been now 1 year. And because it was a deep value add property, even though we had projected some returns, we had told the investors that, if we are not able to, we may not give out any returns, but we are able to keep the property running at high occupancy, and we were able to do the rehab within 3 months.
And you did $2 million worth of rehab on the property. So did you do a bridge loan on this transaction?
No, this was a straight Fannie Mae loan.
So Fannie Mae was going to be able to throw in $2 million worth of rehab on this property?
Yes. In fact, we talked to Fannie Mae a couple of weeks ago, and because we added a fence at the property up in the place, and this literally passed by. They didn't know there was a property there. They turned around, this was a property that we financed.
No kidding. And so this property is paying a rate of return to its investors right now.
Right now, we are in double digits already. We had said that we'll be somewhere in the middle of, 1-digit return.
And do you guys do quarterly meetings with your investors? Do you do 6 months? I mean, how many times do you touch your investor who puts money into these transactions?
We do quarterly meetings, and if everything's going good and investor team start to show less and less, then we go into the yearly meetings. But yearly meetings are there, whether even one investor shows or none. We always will hold a.
And you push out
meeting.
statements on a monthly basis?
Yes,
Every month.
It's pretty standard for we send out a report every month around 20th or something like that. Everybody gets the monthly report with our little bit summary on it. How
so
are
you
we
put
doing?
comments in there
Yes.
because you're an asset manager of the property. So you have
Yes.
the management company that produces the reports, and then you kind of oversee
Exactly.
the property management company, and you put your little notes in there for people should see what's going on. And you may give them pictures of things that you changed, and so they understand where their money is going
Yes.
for.
And one of the things, Paul, we do is when we take a property, we get very engaged for 2 months, and we have our investor get engaged. So every week, we send out our status report with a picture that what we have done and what we have accomplished and what we are going to do. So we kind of tell them what is being done, what is forecasted, and how we completed and where we are. So we provide them a report, and at least about 2 months, and then we know after that we kind of slow down. So we have investors from Paul all over from the United States. We have from California, we have from Florida, we have from Minnesota, we have investors from Utah. I don't know. Georgia, Las Vegas. So having them out of towns, giving them pictures, they do appreciate very well.
Absolutely. But Ricardo, it was a Fannie Mae loan that was done on the property, 30-year amortization, 12-year term on the deal.
Right.
So you didn't have to do a bridge loan. You went right to Fannie Mae. So you kind of set it and forget it and didn't have to worry about it, making sure that everything worked on the bridge loan before you could do a non-recourse Fannie Mae loan. So that's great. Some great information. Anything more we want to talk about on that deal? Is there anything else that we want to say?
No, I think we
covered a
covered
lot.
All right. Let's talk about your last transaction. When did you guys buy this one?
in September of last year.
So 17. So 6, 7, 8 months went by from the previous one to this one. And tell us a little bit about this property.
Right, so we were able to stabilize the property, the first one, before we took over this one. And that's the key thing. We want to make sure that, so property was stabilizing. We were above 90%, 95% on the first property. So this property was, again, in Dallas,
Yep.
288 units. It was a hybrid deal.
And what does that mean? What's a hybrid deal?
So hybrid means it's we will require some upgrades, and part of the units were already upgraded. So it's kind of a think about, I've done a 50% of my job at home. You wanted to replace refrigerator, maybe floor, but the counters were really good. So that kind of a hybrid deal, then you just think about that way. So we had a $600,000 rehab budget on this one. Again, we were able to stabilize this property again in 3 months. With the hybrid, we are doing fairly well on this deal.
So let's talk a little bit about this. This property is called Oak Meadow. Oak Meadow, and it's in Dallas. It's on maybe the east side of Dallas, I would say.
Correct.
Your other properties maybe on a little bit of the west side of Dallas. So and then you have properties in between. But this property was built in what year?
It was in 1980s.
1984.
1984. So it was built right before the tax change in 1986. So it has a number of properties around this property.
Yes, that is true.
So it's kind of like a car dealership where you have a Ford, Chevy, Mazda, all these dealerships are next door to each other. This is like a property that has a bunch of other apartments right next door. Is that good? Is it bad? Tell me what your feeling is about having a property that's one of, say, 15 properties in that area.
It's a mixed thing. You're right. I mean, it can go either way. So a good thing about it is that it's right around a lot of businesses,
Right.
which need, a lot of housing around.
Yeah.
So it's a good thing that we have the property where we have it, and we are able to keep it in mid-90s on the occupancy side. The competition is a lot, but good thing about this property is when we took over, it was one of the properties which were leading all the other properties in the neighborhood. So we did not have to dig and try to, bring this property up. It had the reputation already established among the tenants in that community.
What's your take on that? My dealership comment.
Yeah, so I think it can be a positive, to your point, if you can be kind of the best product, best price, right? So you're in the middle of a ton of jobs, and you're right in the middle of a lot of people that live in multifamily. So your clients are there, and you just got to be the best one on the block. And if you are, you're going to stay full. So I think that's the key: is being best product, best price.
Yeah.
Right. It was already the best product, and we have to, we are working on it to make it excellent product now.
Yeah.
So the reputation is already there. We just have to take it a level high.
And how did you find the transaction? How did it come to you?
This is again, it's one of the things that a lot of networking with the property management company, and happened to the owner wanted to dispose of, and he wanted to get to back bigger thing. He had this property for a long time, so he just came across, and we just jumped right on it, and some of the deals you just can't find. You just take it.
So this is another one that your property management company
Partly, yes.
teed up? Wow.
Yeah.
That's a good property
good.
management company to have.
That's right.
Right.
They're-
Yes, we are
they're
very thankful of that.
Great partner. Sounds
Yeah, it's
like
a great.
partner.
It doesn't happen all the time.
Yeah.
I mean, it could happen because sometimes you find a seller, just like he said. Paul was mentioning. Some of the partnership happened, and they just wanted to move on, do bigger thing. They wanted to bigger. The first one is that we bought some commercial property. This one wanted to go different route. So, yeah.
So tell me a little bit about, you guys did not put a new loan on the property, but you guys had to assume the loan with the seller who had taken it out maybe a year or two before.
Right.
Does that happen very often, Ricardo, with properties, that somebody who's buying the property has to assume the new loan or the loan?
Yeah, so it's kind of a mix, right? So ideally, and in a perfect world, you'd love to be able to always add new debt, because usually you can get better leverage. But in a case where new debt had recently been put on, which was the case here, the prepayment penalty was probably just way too much to be able to overcome. So in that scenario, the next best scenario is to assume the loan, and then from there you can do other things to maybe add debt to the deal. Supplementals are available, things like that, which I think we'll get into. But it is common. It is common. People put long-term debt on properties thinking they're going to hold it long-term. And for whatever reason, the market changes. They need capital. They decide they want to get out. And the only kind of feasible solution there is to assume it.
He had bought the property how far in advance of when you guys bought it? Was it 18, 24 months? Or how long did he own the property before he sold it?
No, this one actually, he had property for 10 years actually. Probably, I think long term. He has a long term.
But
yeah.
he had
refied
about 18 months before.
So he refinanced, and now, just like Ricardo was saying, is that there was a large, significant yield maintenance or a prepayment penalty on the property, in that you guys could go out to the market and get brand new Fannie Mae debt, but the prepayment penalty on that size of a loan was $3 million. I mean, it was
$3 million.
It was a big deal. So the only thing he would have done is increase the sales price.
Exactly.
And you don't want. I mean, nobody's making any money except for the bondholders of Fannie Mae. So the seller's not making any money. The buyer can't put more money into the property. So it just made sense to assume the current Fannie Mae loan. And so when you assume the loan, you have to put together a buying team to do it. So how many people in the cockpit, the KPs and the guarantors, how many people were together in that one?
It's a big deal, and there are 89 people altogether in this one.
89 limited partners and KPs.
Altogether, yes.
So how many KPs were you? Is it 3, 4 KPs?
Three KPs,
Three
including
KPs.
us.
Including us.
Okay.
So 2 more.
And so you guys got the transaction under contract. You're going through the assumption process, and what they were trying to do is assume the loan that from the seller, and they were going to have to raise money to buy the deal. So they're assuming the loan. They're going to have to raise money, and that they were thinking, hey, listen, if we can't raise the difference between what the sales price is and what the loan amount currently is that we have to assume, we're either going to have to raise a whole bunch of money, or what Fannie Mae will allow is a supplemental. And so, Ricardo, tell us a little bit about what a supplemental is.
Yeah, so it essentially allows you to lever up, assuming that performance has been there and you still have a good debt service coverage going in. Fannie Mae will allow you to add additional debt. It's kind of like taking a second loan.
Yep.
Well, it is a second loan. It's coterminous with the first loan. And again, depending on property performance, will determine how much of a loan you can get. Max is usually about 75% leverage in the deal, but assuming you have good debt service coverage. So in this case, I think the property performance was there, and we did some underwriting, and we were able to come up with a decent size supplemental.
So that supplemental, I think, was for $3 million or so.
Okay.
And so we did the application for the assumption. So we were just, again, assuming the loan. So we're kind of changing jockeys on the horse. We're just keeping the horse. We're just changing jockeys. The seller's saying goodbye. The Sharmas are coming in to be the new jockeys on the horse. And now we were also we did an application for the supplemental. Again, the supplemental was $3 million, like Ricardo was saying. And then we were going to raise the difference. What happens is that when we're raising the money, you tell me, what happened when we were raising the money?
So we, held a meeting with our investors to raise the money, and the interest was so great that not only, we raised the money, it just overspill way above the amount that we were looking at. People really loved the deal and the return it was providing.
So they came in, instead of raising X, you guys raised X times plus X plus X plus X. So you guys had actually raised so much money that they really did not need the supplemental.
That is correct. Yes.
So you raised so much money that between the sales price and the loan amount plus the rehab on the property that you guys wanted to do, because you had to raise the rehab dollars too.
Yes.
You by having a meeting. And tell us a little bit about that meeting. I'll get to my point in a second here, but tell us a little bit about that meeting. You guys do something a little bit special that you don't do a webinar, so to speak. You guys do a little bit of a dinner, and it's almost like a party. Would you say so?
Yeah. So it's really not a party, Paul. What we like to do is we like our investor to get involved. Investing in a deal is you can go invest anything. We like to have a personal relationship with the investors. We want them to come and see us, meet us, talk to us before they give either $10, $15, $20, or $100,000 or even more. So that's what we did. We invited open invitation to a number of people. We had almost 200 and something that investors in that hall. We presented them. We brought our team. We presented our property. They had the flat for the property, what they're getting into it, and we just explained them how the property is going to go. We invited our lender. Paul was there and help us out how the deal is going to work through for the financial perspective. We had our attorneys and everyone out there just to show. And we do provide dinner. I think it's just a part of the fact that we want to make sure that it was evening time. So
yeah, it was
Right,
it was a nice event.
Right. Yeah, but we are very big on team building, right? And team is very important to us. Matching, the right chemistry with our investors is a big deal to us. Because in any deal, we are not sure if it's going to go the right way, or there will be some
Hiccups.
Hiccups along the way. But if you have the like-minded people on the team, then decision making is so much easier. And so that's what we tried to do, is we wanted our team to meet all the new investors as well as existing investors all under one roof, and that was the purpose.
So you had huge interest in the deal, obviously, from an investor standpoint. So now you've got a decision to make, right? Do you take lower leverage and let more investors in, or do you cut it off and take the supplemental? What was your decision process? What were your thoughts on how did you make that decision?
We did full financial analysis with or without supplemental.
Right.
And taking higher leverage was the better scenario. And then we sent out for voting among the team that we had chosen as to, which way do they want to go. And everybody was on the, without the supplemental. And we had the funds to do that. So that's how we
And
decided.
one of the beauty was not taking the supplement, and we were able to collect the fund. Is the interest rate for the assumption was 3.87%.
So the first lien against the property currently was at 3.87%, which is a great rate, and you probably would have gotten a lot higher for the $3 million
Right,
piece.
yeah.
So you had too much money, which is sometimes can be a problem, but it was an opportunity. It was a problem what way? What did you find out after you, unfortunately, as I say that, unfortunately you raised too much money in this transaction and you weren't going to need the supplemental? What happened?
Well, something that we weren't expecting, but the lender came and said that since you have filled out the application for the supplement loan, the fee
And the loan was approved, and you had paid the fees for the appraisal, because you almost have to do a brand new loan for the supplemental. It's like it's a $3 million brand new loan, so you have to have all third parties done, the appraisal, the underwriting of the deal, and then the loan gets committed through their committee. And you said, we've raised too much money. I don't think we need to have that supplemental. The lender came back and said, that's good news. So thanks for not, you don't need our money. But the bad news is that we're going to still charge you the 1%, the $30,000.
Yep.
They didn't waive that, so they held that. So even though that you didn't get the $3 million, you still had to pay the lender, Fannie Mae's fee in that deal. So our piece to you out there listening is that if you have any inclination that you're going to be able to raise too much money, or not enough that the supplemental doesn't need to be used, don't sign the supplemental application for a new loan and just hope to do it and avoid a $30,000 hickey. So we wanted to bring that up as a point of interest.
And I think, Paul, just to add that is, it's a read the fine print.
Right.
And, some of the word can be really turn you around.
Yeah. Now, we didn't use the supplemental now on the acquisition, but we can use it down the road. So after 1 year, if you guys want to come back out and get another supplemental or the first supplemental and pull cash out of the deal, we certainly can do that. So even though we didn't use it on the acquisition, we'll use it on the kind of the cash out of the property.
And at that point, you'll probably be able to get more than what you would have, because your NOI is continuing to go up. You've made further improvements. So it'll be a larger carrot.
Yeah, you can only take out a couple supplementals, so to speak. One, when you say you buy the property and you're assuming the first lien, then you're looking for a supplemental second lien. You can take that. Or if you're looking to sell the property and somebody who's buying it from you, they can take out a supplemental and do that again. So, but this one is a possible refinance down the road to pull more cash out. So you're absolutely correct.
Yeah.
Right. No, and thanks to you, Paul, for, at that last minute when the lender was going to charge the fee, at least we worked out the deal that fee will still remain intact when we are ready to get the
even though they
next
they
time.
charge the $30,000, we kind of negotiate that when we do take the money out, that fee will not be in there. So that's good. That worked out well. Anything more to add on that property?
Just to add those, since we own the property, our property is stabilized, just like I said. We are doing upgrade. What we need to do, as we said, even this hybrid deal, we forecast that we were not going to pay for 6 months to a year, depending on how we could do it.
To your investors.
To the investors. And we were able to pay in first quarter on this deal.
Wow.
Same as Sierra Vista. So it doesn't always happen. We try that way. That, we want to make sure that we are delivering to our investor. It does require, we did a lot of upgrade on this unit too. We remodeled our office completely from scratch. We had put brand new sign there. We did driveway work, some concrete work. We are also adding to our property is pergola and adding some grills, so they can enjoy. We do have a pretty nice pool, like a resort area pool.
Is it a gas grill or is it grills like you see in the forest preserves?
It's a coal grill. We try to avoid gas, even though we have a gas line right next to it, but we try to avoid the gas. It's kind of we don't want people to take advantage of this. If somebody leave the gas on, then we are trouble. So we bring the coal and burn the coal and out.
That's great.
Right, and this is where taking the property to the next level. So even though there are so many apartments right next to it, we are still able to manage the high occupancy.
And adding a sign, changing a sign with a bright color, we get a lot of traffic, walk-in traffic. Even though so many apartments, Paul, you mentioned that there's a lot of walking traffic there.
Yeah, going back to that one point is that you can have a car dealership all by itself, and the car dealership may like being all by itself, but that's why they build these auto malls, having all these car dealerships, because it kind of becomes like a regional place that people go. It's a destination place where people go to buy cars. It's the same thing when they go to look for apartments. They want to go to a kind of a regional area where the apartments are. So, anything more to add? How are property taxes this year? And don't roll your eyes when you answer that question.
Luckily, these two properties are not in Tarrant County.
Yeah.
In Dallas, the taxes have not been raised to very high level. But like we do every year for all of our properties, we will protest and try to bring it down, lower it down.
Does that cost a lot of money to protest the taxes?
It's really not that much with the amount of money you will save. Is very it's a fraction of cost. Seriously, I think we encourage everyone to protest the property, whether you think it's a very little or more, because it's going to add up. If you save $200,000 actual value, think about next year. That will add to your next year. So.
No, that's absolutely right. I mean, it only goes up, right?
Correct.
Very rarely do you ever see anything come down. So if you miss a year, for example, we're going through a couple of transactions right now where taxes just came out, as Paul said, and what we're trying to do is make sure that the buyer is trying to make sure that the seller is absolutely protesting and we don't miss a year. Because if you miss a year, it just escalates going forward.
Right. Yeah. And if you have the right attorney who will only charge you if they are able to protest and bring the value down.
It's performance-based, right?
Performance-based, right. And that's how we work. So it really helps.
So finishing up on the podcast here, because we've gone for a long period of time, and people have driven home 3 times since listening to this podcast. Any things that you would tell people that you know now that you wish you knew 2, 3, 4, or 5 years ago? What are some of the insides that somebody that's wanting to get to where you're at right now, where Fatima, you work, but who knows for how long? I mean, I know you love what you do, so that's good. But be able to be in a position like your husband, that he was able to get out of his corporate gig and get into the apartment business. Any words of wisdom to people that are thinking about getting into apartments?
So, like we said earlier, we both are from corporate America, and we knew the advantage and the strength of a team. Had no idea that kind of a team would be needed for our real estate transactions too when we started looking for real estate. But that is absolutely necessary in here. You need to have a team of your lender, your mortgage brokers, your attorneys, your management company, your KPs or key principals, or the guarantors for your deal, as well as your passives. It's very important that there's a good chemistry match to take you to the next level of success.
I can tell you on that team thing, the MVP out of all those people is your property management company, at least your property management company. We're not going to mention that property management company name, but get to know the Sharmas. So just finishing this up, one of the things we brought up in the first time that made you guys successful is that you were able to learn from the person that's kind of gave you an opportunity to invest in their deal. They kind of walked you through what you should be looking for. It really gave you a sense of understanding a little bit more about this thing. Are you in a position to try to, if somebody wanted to invest in some of your deals in the future, would you kind of help them understand a little bit more?
Yes, Paul. We're always open. We have taken people who wants to be KP just because they want to be a future lead. We have taken investor from very low amount. I can say $25,000 to just to get them because they want to learn the real estate.
Yeah.
So we are very open. We encourage our members to come in. If you need help, we're glad to help them out.
Yeah, but you're not educators, you're not mentors, you're just KPs. Tell me with the group that you guys are with that you thought did a great job at educating you. Lifestyles Unlimited.
Yes, that's true. We join Lifestyles, and our lifestyle has totally changed.
Right. That is very true.
So they've done a great job by educating you and mentoring you, and you guys have done a great job. And my congratulations. Move on to your new stepping away from the corporate industry. And I know at some period of time, your bride will do that down the road. If somebody wanted to get a hold of you, at least engage you in a conversation, what's the best email address for them to reach out to you?
It is 7cshld@gmail.com.
One more time.
7Cs, SEAS, HLD, which is for holdings. So the word together, 7cshld@gmail.com.
That's great. Ricardo, anything else to add?
We appreciate you guys coming out. Great stuff.
Our pleasure. Thank you.
We appreciate that's the Sharmas. Ricardo Hinojosa, thanks for joining us today. We wish Michael Becker the best in closing
Always.
his next deal. So again, I'm Paul Peebles. Have a great day.
Thank you.
Thanks for listening to the Old Capital Real Estate Investing Podcast. Please join us at oldcapitalpodcast.com to sign up for our weekly email updates. We'll see you next week for another great interview.